Good morning, everyone. Today, we're going to delve into a fascinating aspect of our modern economy: the intricate financial interdependence of Apple, Alphabet, Amazon, and Meta. We often perceive these tech titans as rivals, locked in fierce competition. However, a closer look reveals a powerful, Silicon Valley symbiosis, a strategic ecosystem where their success is deeply intertwined. This isn't just about headlines, it's about understanding the foundational economics that drive their continued growth and, crucially, what that means for your investment portfolio. The market often sees rivalry, with headlines dominated by big tech wars, battles over operating systems, privacy, and advertising revenue. This public narrative paints a picture of zero-sum competition. But for the astute investor, the balance sheet tells a different story, one of a powerful, symbiotic alliance. The reality is, revenue streams are deeply entangled. Consider Apple as the stage, providing the hardware and the immense install base. Alphabet, Amazon, and Meta then provide the performance, their services and utility. For investors, this isn't a war where you need to pick a single winner. It's a cooperative ecosystem where Apple's continuous hardware innovation acts as a rising tide, lifting all these service-based boats. Understanding this dynamic offers a unique investment opportunity. Of course, we can't ignore the surface narrative. It's clear there are genuine battles being fought. We see the OS war, with iOS and Android vying for global market share. There's the privacy war, where Apple's app tracking transparency features have certainly clashed with Meta's ad revenue model, causing significant ripples. And let's not forget the attention war, where every platform is fighting for those precious, limited minutes of user engagement. These are real challenges that shape the competitive landscape, but they are just one layer of a much more complex financial relationship. It's crucial to look beyond these immediate skirmishes to grasp the deeper, more enduring connections. To truly understand this dynamic, let's look at the underlying mechanics, which we can describe as the relationship between infrastructure and utility. Think of Apple as the landlord. They control the physical gateway, designing and building the most advanced hardware. Their goal is to build the steepest, most capable hill, through unparalleled chip performance and screen quality. Now, Alphabet, Amazon, and Meta are the tenants. They build the snowball, their heavy, feature-rich apps and services. They rely on the hill's height, on Apple's powerful infrastructure, to gain the momentum for their intensive applications. The thesis here is simple, yet profound. As Apple continuously improves its hardware, these tenants can build heavier, more complex software, which in turn increases their own revenue. It's a virtuous cycle of innovation and profit. Let's zoom in on Alphabet, which we could call the multi-billion-dollar Trojan horse in this ecosystem. It's a fascinating paradox. Alphabet is arguably Apple's most significant rival in many areas, yet it's also one of its most lucrative tenants. Google pays Apple an estimated $20 billion annually just to remain the default iOS search engine. The strategy for Google is clear: the iPhone acts as a Trojan horse. Apple distributes the high-quality device, but Google then monetizes the user's valuable time spent within their services. As iPhone sales continue to rise, the user base for Google Maps, YouTube, and Search grows exponentially, ensuring a powerful and consistent revenue flow for Alphabet. Next, consider Amazon and its approach to accessing what we call the premium economy. For Amazon, the iPhone isn't a competitor, it's a digital red carpet, leading directly to the world's highest-spending consumers. The insight here is crucial. iOS users historically possess significantly higher purchasing power than the average Android user. This creates a valuable moat. The iPhone, therefore, serves as Amazon's high-end storefront, a demographic filter funnel that efficiently converts premium traffic into high-margin transaction volume. By understanding this, we see how Amazon strategically leverages Apple's ecosystem to tap into a highly valuable customer segment. Now, let's address Meta, where we've seen some clear friction in the machine. Apple's privacy changes, particularly app tracking transparency, created a significant wall that restricted Meta's ad tracking efficiency, costing them billions in revenue. This conflict is undeniable. However, here's the crucial counterpoint: Meta absolutely needs Apple's high-performance silicon. The complex algorithms, the AI-driven feeds, and the demand for high-resolution 4K video all require the cutting-edge computing power that only premium hardware, like Apple's, can provide. So, while there's friction, there's also mutual dependency. Meta's strategy reflects this. Android offers the sheer volume and a data treasure trove, while iOS offers the value of premium engagement and powerful hardware. This brings us to the hardware-software innovation flywheel, a powerful engine driving sustained growth for the entire ecosystem. It works in 3 steps. First, Apple innovates hardware, consistently delivering better screens, more powerful chips, and advanced neural engines, creating significant headroom. Second, the software giants Alphabet, Amazon, Meta eagerly utilize this headroom, pushing the boundaries with YouTube 4K, Meta AI, and Amazon AR experiences. And finally, this heavier, more sophisticated software then compels users to upgrade their hardware again to fully enjoy these advancements. The hill gets steeper, allowing the snowball to get bigger. Neither can truly accelerate without the other, creating a self-reinforcing cycle that fuels continuous innovation and value for investors. Given this interconnected landscape, our investment thesis is to bet on the cluster, not just a single winner. This is not a zero-sum game. The continued success of the iPhone, for example, actually creates a larger overall pie for search, commerce, and social advertising, benefiting all players. This alliance creates a significant moat around these companies. It's incredibly difficult for new disruptors to break into a market where the hardware host and the software giants are so deeply and financially incentivized to keep each other thriving. So, our strategic outlook should focus on co-opetition, understanding that public rivalry often masks a much deeper, private revenue sharing and a shared interest in the overall health of the ecosystem. This understanding provides a more stable, long-term investment perspective. In conclusion, the future of this tech landscape is truly a joint venture. Apple's success isn't just about Apple, it acts as a signal flare, illuminating and accelerating the growth for the entire ecosystem. The key takeaway for every savvy investor is this: do not get distracted by the superficial, war narratives. Instead, watch the flow of money, understand the underlying symbiosis, and invest with a long-term, strategic perspective. Thank you.